Hello everyone, Joshua Hayes at BigWaveTrading.com. Thank you for taking your time today to watch the video lesson. There is a ton of content on YouTube, and I really appreciate it taking the time to watch the video lessons because everything that I do is relevant, important information. If I go over or talk about anything, please listen. It is from decades of experience, I guess it is decades, it's 20 years now of experience, but more importantly, I use Occam's razor. I'm very scientific method-based approach to this game. There are no biases, there are no wishes, there are no wants, there are no expectations on my end. So I come to you completely unbiased and just want to give you the information that's relevant. So that being said, there's a lot to go over. I am not a professional video maker. I am not a professional content provider. I am a trader. I trade for a living on the island of Maui in Hawaii, and I take this job seriously. Do you know what time I was awake on Maui in the morning on Friday? 1 a.m. Why? For stocks like AMAM. And you're going to see, I don't think it's going to be marked up on this chart. Nope, because I'm on my leaders tab. But if we go to the day trading tab here and look at AMAM, edit chart. Oh, we already got the pre-market data on there. Go back. You can see the markups from the pre-market all the way to the highs of the day. I bring this point up. We're going to go to the 5-minute chart because our time frame is intraday, basically. That is our focus time frame. On Tuesday, what was the stock that we talked about on Tuesday as the stock in play? SMMT. What was the stock on Wednesday that we focused on? RNAZ. What was the stock that we focused on intraday at Big Wave Trading in the chat room? And we are not an intraday service, but we go to where the games are, PHVS. And what was the stock we focused on Friday intraday? AMAM. I bring this up because the only time frame that I am aggressive currently during is intraday. And I love small caps, trade small caps intraday. These are my focus. I will also trade big caps. I have no problem going into the big cap land. And you can see CVNA in here on Friday. But these are the stocks that I was watching and playing on Friday. So this is where my focus is intraday. I'm looking for these kind of moves, the 700% moves intraday. Why am I focused intraday? Because on the end-of-day basis, things are not that good. So getting back to the SPY chart, we had a very powerful day on Wednesday, back above the 200 SMA. Now listen, look what happens when I show all the resistance, anchored VWAP, Fibonacci retracement levels. Blam! We are range bound, guys. Look at all of these key inflection levels, moving averages, anchored VWAP lines, pivot, Fibonacci retracement levels, pivot point levels, downtrend lines, resistance support levels. They are everywhere here. To expect the market to do anything amazing anytime soon would be insane. Why? Look at whenever you're clearly uptrending above the 200, 150, 100, 50-day simple moving average. Things are easy. You don't have all of these lines and all of these levels on the chart. So with that being said, you can't expect a whole lot here. But in the short term, immediately following the 200 SMA reclaim, we basically sold it completely off. And that is not good. In fact, we started December with 5 straight down days, 1, 2, 3, 4, 5 on the SPY. That is the first time that's happened since 2011. I don't know if you guys remember about 2011, but there was an additional 15% drawdown that year. So keep that in mind. One of the biggest problems I have with this uptrend, though, is the lack of quality signals. When I say complain, I'm doing it with quotation marks. I don't complain about anything. It is what it is. Like I said, no bias. But the biggest quote problem that I've had with this rally attempt off the October lows that I did not have off the June lows to the August highs, off the March lows to the late March highs, is grade A signals. I actually had I had a couple of grade A setups during this rally in my signals that I look for. I had a few grade A signals during this rally that I personally look for, It involves an indicator on Warden called balance of power and a volume truncation with price and volume characteristics, chart pattern, what have you. This rally attempt, my signals that I like, they're going to look something like GRBK here off the 200 SMA with this kind of volume surge. The BOP is not shown on the chart, but you have Chaikin money flow green here. So let's just call Chaikin money flow. And we're triple green on these indicators. I'm going to remind everybody, price and volume is all that matters. Get rid of all of these lines and all of these indicators. I am fine. These are tertiary or secondary or quaternary confirmation like signals, but I would never trade off of them alone. I just need price and volume. That being said, GRBK I would consider a grade A standalone setup. And as you can see, 27% gain in a very short amount of time. So that's what I'm talking about. I've had none during this rally attempt. On top of that, I don't have any grade A can slim setups. Everybody, we're all focused on ENPH, but guys, this is not a grade A consolidation setup. Look at the moving averages. They are stacked properly, but look at this price action. Do you want to see what a grade A can slim setup would basically look like? So if we go back here, you can see this move here. Look at how you come up off here on PBT. You have a base on base. You get super tight. The moving average are stacked. But more importantly, notice how the 50, 21 EMA, 9 EMA, and 5 EMA are very close to each other. And what does it do? Ba-blam. So that's kind of like in 2021 what I'm looking for with PBT. It actually had a pretty good setup. I'm thinking of a different stock, aren't I? Damn it. Go wasn't great, but even Go's setup was better back here in June. You had the pocket pivot point signal, the squeeze, the 50, 21, 9 are all pretty close. And what did Go do in June? So in terms of can slim setups, this is what I'd like to see. My favorite current setup out there right now is MODN. I personally have already gotten long early on MODN, but it's not necessarily a perfect setup, though it is pretty close. We got at least a tight squeeze going along. Moving averages are stacked properly, and we're getting pretty tight. But still, these setups are just not there. So that's my whole point. This entire rally, these setups haven't been there. So I've already been on a little bit of a, what's going on here, guys? But the biggest problem I see, the DIA, look at it leading. The QQQ, look at it lagging. But more importantly, when we go for the super speculative area of the market, ARK, look at it. It's off its lows. And if we go for the growth leaders, FFTY, new 52-week lows on Friday. This is not saying anything about the IBD 50. The IBD 50 is where you want to be in good markets. Look at the 2020 bottom to the recent highs. Nice 89% gain with this index. And here we are at 52-week lows. So that kind of tells me, a little bit. I pay attention to that. Also, XLV, look at how strong this chart looks. XLF, looking pretty good with the DIA. XLE is starting to roll over a little bit. XLRE and XLP, these were the leading sectors this week in the market. We're starting to see the defensive names like the DIA really start to showcase some leadership versus the QQQ. Hey, at least NVIDIA looks good out there. But the bottom line is these big cap, slower growth, more recessionary resilient stocks, they're holding up relatively well, while our growth names and what should be our leading indices are hitting new lows. I review these charts because what I now want to say is that I'm going to go ahead and tell you, so 2022, I deemed it the year of the day trader. Those that day trade the market in 2022 will have a much better time and more profitable methodologies and strategies and chances to make money in this volatile environment than a swing trader, position trader, long-term investor. Did that analysis prove to be proper? I would say so. I would say that I nailed that analysis. Started to sell my long-term portfolios in July. Got to 50% cash in October. Then we had that last leg of the rally, and I was like, uh-oh, I've made a bad choice. Nah, I trust my instincts. Hard rule number one in big weight trading, always cut your losses. Hard rule number two in big weight trading, thanks to Marty's why, You never fight the Fed. Never fight the Fed. And is the Fed cutting rates? Nope. Is the Fed buying assets on their balance sheet? Nope. So I still don't want to fight the Fed. But 2023, I am calling 2023 the year of the recession. We are going into a recession next year. So on top of the year of the recession, the theme for 2023 will continue from the theme of 2022. It is going to be the year of the day trader, the active trader, the trader that takes positions on overbought tapes for oversold moves lower. Traders that take position on oversold markets for moves higher. Those that are active in the market are going to do the best. And whenever I speak of being active in the market, I speak of day trading. So the reason why I believe that we're going to go have a recession is there's a multitude of factors. And we're going to start going over them with charts. But the first thing first, before we go through these charts, I want to make mention. The equity put call that we were just talking about recently is useless. For my entire career, I've always wanted to see a VIX above 40 before I can even consider looking for a bottom. I need to see this market, this index, the VIX, above 40. Notice in 2020, we get above 40 in the VIX. What happens eventually? A bottom. Let's do a weekly chart here. Let's look at 2002. Look at 2008, flash crash, 2011 pull, the 2015 leading to the 2016 market bottom, the 2018 Fed pivot, and then once again, 2020. So the VIX needs, for me to even think that the market is bottom above 40. Where are we at right now, guys? And how has this range been working for the VIX this year? When we're down here, we sell off. When we're up here, we rally. When we're down here, we sell off. You get the picture? You get the point? Where are we at right now? We're down here. So what do you think might happen? So keep that in mind. I bring that up. And once again, guys, I'm not a professional videographer. The put call ratio that I have always used to determine if I am in a good market or a bad market, looking for a bottom with the VIX, I've always wanted a put call ratio over 1.2. Now, it's normally volatile on a day-to-day basis, but look at what we're seeing since November. 0 DTE options, I didn't think that it would affect the equity put call ratio, but clearly it has. So in this video lesson, I'm going to say it right now. I have to find out a new way to calculate moving forward how I'm going to use the CPCE, the 5-day moving average. Look at how choppy it is. That won't even work anymore. I'm going to have to look at something different because to me, this metric that I've always used to gauge bottoms with the VIX is dead for now. Now, maybe we're just resetting new levels. Maybe the next time the VIX is over 40, the CPCE needs to now be over 2 to confirm a bottom. But either way, to me, the CPCE is like this X button. It's dead. So that's that for volatility. And to judge anybody that thinks that equity put call ratio called a bottom, you can forget it. We'll just be focusing on the VIX for even a chance at calling a bottom anytime in the short term. And as we head into a recession, we're going to need to probably see the VIX get all the way up to here. But here's my biggest concerns with the overall market as we move forward. If I haven't shown you enough on the short term via the IBD 50, via the DIA leading the QQQ, ratio charts are starting to roll over. Here's where my biggest problems are. First things first, I've said to never fight the Fed. So I'm going to pull over another chart, pull this one over. This is the Fed funds rate. When the Fed is cutting rates, you want to be a buyer of stocks. And when the Fed's cutting rates, at some point, you bottom. In 2003, the stock market bottomed. Fed stopped cutting rates in 2004. You know what happened. The market starts selling off. Fed starts cutting rates. The market bottoms in 2009 as the Fed is cutting rates. Fed is hiking rates. The Fed pivots. We have our extremely strong bull market off the COVID lows with the Fed cutting rates. So the Fed is cutting rates before we bottom in 2020. The Fed is cutting rates before we bottom in 2009. The Fed is cutting rates before we bottom in 2003. What is the Fed still doing? Are they slowing the rates? Yes. But are they cutting? No. So here's the thing. If this is 1994, the market actually bottomed while the Fed was still hiking rates, initially rallied when we had a pause in the rate cuts, and then in 1994, the market exploded higher after we finally started to cut rates. And Mark Minervini, one of the greatest traders of our generation, did not start getting aggressive until the Fed started to cut rates and still returned over 300% in 1995 after the Fed started to cut rates. So if you're looking for a bottom as the rates are rallying, you can be on the lookout for that, for sure, for a market bottom. But trust me, before a huge market rally happens, the Fed will already be cutting rates before a bottom. And after being in a bear market since really February 2021 on the IWM, which a lot of people continuously do not talk about, the IWM, it broke out here and it topped out here, but using the stocks that I look at, like ARK, those high growth names, we've been in a bear market since February of 2021. So keep that in mind. So not only is the Fed not cutting rates, these are the balance sheet trends. The biggest buyer in the stock market, the Federal Reserve, they were buying stocks until they weren't. Are they buying stocks yet? No. Are they still running off their balance sheet? Yes. So the biggest buyers of equities is still selling equities. Keep that in mind. Because now the charts I'm going to show you are my biggest concerns for this market. This is not a fully up-to-date chart. I will be posting the fully up-to-date chart right after I show you this one. Inflows to equities. This is the whole thing for me. 12-month equity inflow, outflow. Before the 2009 bottom, what was retail doing? For years, selling. Before the 2016 bottom, what was retail doing for years? Selling. Before the 2022 bottom, what was retail doing for years? Selling. Do you see this chart? Let's look at the updated version. It's not even updated. This is as of 2 weeks ago. We have been in a bear market for growth stocks since February 2021, and we've been in a bear market all year long. Yet retail equity inflow is at all-time highs. Retail hasn't even come close to selling, to panicking, to withdrawing funds. This would be, if we have a bottom in the market, this would be the first one ever after such a prolonged period of selling in the market that came with equity inflows at all-time highs. Crazy. Now, what I want to talk about is, I couldn't find a line chart, but look at the equity inflow outflow, okay? So everything that I've shown you on that chart, I believe, went back to about here. Now, before the 2008 low, you can see there was never really any huge equity inflow. And as you see, this is a very old chart, so ignore all of this. You just saw what it's looked like for the equity inflow in the most current chart. I bring this up because we've gone on for so long. There's only one other period in my career. I don't have this chart. I don't have the data going back beyond 1996. The only time in my career that I've seen the market sell off for a prolonged period of time, and yet retail kept buying the entire pullback, was 2000 to 2001. Do you see when retail starts selling? Do you know what that event was in 2001? 9/11. I'm not saying that we're going to have another 9/11 in the market, but it took 9/11, a black swan event, before retail went, oh my God, what are we doing? We're wrong. Time to panic sell. And that then led to the 2002 bottom. And guess what wasn't happening anymore? Retail inflows. I'm not saying that I don't know what the black swan event is going to be. I don't even know if there is going to be a black swan event. But with the way that retail is buying, I believe it's going to take one to knock it off. So I'm going to bring over one more chart confirming my analysis. And this was posted during the Market Smith YouTube video on Friday by Scott St. Clair. I do not know what this fund is, but look at this. Look at these returns. Look at the returns in 2020. Let's just pretend like it's the chart of the fund that we were looking at that topped in February 2021. Look at those returns in 2020, 224%. Look at those returns in 2021. Now look at those returns in 2022. After 2020, look at the assets under management. After this firm reported a 220% increase, look at what assets under management did. After a 15% drawdown, after a 70% drawdown, look at where the assets under management stand. Retail hasn't even begun to panic. And after this long of a bear market, I think that they're going to have to, especially whenever we think about that this is probably going to be a recession year. And if I expand this chart, look at 2000, look at 2000 to 2006 to 2008. Look at our 2-year and 10-year spread now. How are we not going to have a recession in 2023? To me, it seems inevitable. All right, sorry guys, we'll try not to make this too much longer. So I'm going to show you a few winning positions that we have just to show you not everything doesn't work in this market. However, ask me, do I still have a position in Mobileye? No. Why? Because right now our rule of big wave trading is if anything goes up 5% after you get long, you immediately move to stop to break even. Listen, that's not normally the case. Normally, we wait till it's at 20%, then on the final stop we do break even. But 2 weeks ago, I started to change everything. And I said, if it's not green immediately, if after day one you have gains, stop's got to go. We got to cut our losses. MDB. I got long MDB on Friday at 195.74. As soon as it hit 198, I put my break-even stop at 195.75. Guess what got hit? My break-even stop. No harm, no foul. That's how we're operating on an end-of-day basis, guys. No read it loud. You get long, and it starts to work. We take profits at 5%. Then we take profits at 10%. Then 15. Then 20. And once we're up 5%, break even stop. So I, obviously, after taking profits on this move here, was knocked out of Mobileye. But on an end-of-day basis, it's still up 19%. And I show you this because if this was a raging bull market and a good uptrend where everything was working out, Mobileye would be up 40% and I would still be long. Do you understand market conditions? NRGD. This was the signal here. On an end-of-day basis for big wave trading members, we're up 45%. But after these gains right here, what do you think I did? Break even stop. I got knocked out, but not everybody did. I'm still tracking it for members that are still long. And in a normal market, we would still be long. But now here's the two winners that I still have a piece of that's going very well. SMMT swing, 69% gain for the culture in 3 days. NMTC, 1, 2, 3, 4, 5, 6, 7 days, 100% gain in 7 days. This is normal for us in a good market. And we'll get size in these names in a normal market on an end-of-day basis. But on an end-of-day basis right now, we're operating very tight, and we have a lot of break-even stops. So we either make money or break-even stops. There is no other option. And that's how we're doing it on all of our swings. Intraday, we're going to day trade the hell out of those AMAM, PHVS, RNAZ, SMMT movers. On the end-of-day swing side, break-even stops immediately. If we get long, shows green, break even stop. No questions asked. That goes for everything. Doesn't work like that in a bull market. It's the way that we're operating right now. On the end of day can slim swings, no grade A setups. On the end of day can slim positions, no grade A setups. Break even stops remain. long-term portfolios, guys, I have made it clear, and I am not deviating. When I sold, half of my long-term portfolios should have gone all cash on, but the problem is this bounce here. Oh boy, my God, I didn't get SPY 350, and right here, I was really worried that if we went to new highs, I was screwed. Same thing right here. Didn't get a close below SPY 350, so I couldn't do my 50% buyback ad, and I still cannot until I'm below SPY 350. If we kept going to new highs, oh my God, I'd be really upset if I went 100% cash here. My game plan for the SPY hasn't changed. Right here, I told you, when SPY hits 400, I'm buying some of my long-term portfolio. When SPY hits 380, I'm buying more. When SPY hits 350, right here, told everybody, when SPY hits 350 on a closing basis, 50% big buy. SPY hits 320, buy more. SPY hits 300, buy more. SPY hits 280, buy more. SPY hits 250, my long-term accounts are all in because historically speaking, that is the most the market falls in any bear market, 55% outside of 1929 before the enactment of the Federal Reserve. And that is still my game plan. There's no deviation. If you're under the age of 40, each time the market falls the levels I just gave you, you can buy TQQQ, SPXL. If you're in between the age of 40 and 60, you can do QLD and SSO. If you're over the age of 60, just buy SPY and QQQ. If you've watched this video lesson, you got the marching game plans. SPY gets to 350, guess what I'm doing? 50% of my long-term portfolios gets invested. 320, same. 300, same. 280, same. 250, all in. And you can just buy the SPY and QQQ, SSO, QLD, or TQQQ, SPXL. All right, super long video lesson. We went over a lot. If you learned something, if you appreciate all of this hard work that I do, please, guys, show some love. I didn't even get 10 likes in the last video lesson. I got like 3 comments. I don't even know if anybody reshared. Guys, show me some love. I do this for you guys. I don't do this for me. All I ask is for some kind of love. Please show it. Show me that you're learning something from these video lessons. And hopefully you're making some money off these video lessons. I do this for you guys. I don't do it for me. And also, if you're emotional right now, stop trading. Get out of this market. This market is going to destroy those that lack the emotional clarity to handle choppy prices. Wait for better times. All right, everyone. I love you guys. Aloha.